Welcome to the Cash Flow Guys podcast. Join Tyler and his team as they unlock the secrets to achieving financial independence through wealth-building strategies inspired by Robert Kiyosaki and other thought-provoking leaders.
Learn to build leveraged streams of cash flow that land in your pocket and improve your quality of life.
Gain access to cutting-edge ideas that will increase your productivity and streamline your success. Find out how to supercharge your retirement plan so you won't have to retire with a pay cut.
You can escape the rat race.
Are you ready?
It's time to Learn to Earn with Tyler Sheff.
Welcome to the Cash Flow Guys podcast. It's that time again. It's Friday morning. It's bright and early. We are here with another great guest. This time I brought in, guy's a heavy hitter. I got to tell you, I worked with him recently. We were both raising capital on an opportunity up in Alabama. Great guy. I've known Lane for a while. We actually did an interview a while back, but you know, Tyler got done playing with the technical files and it kind of got lost. So introducing back to the show for a second time, although you folks have only heard him this time, Lane Kawaoka. He is a full-time civil engineer and a real estate investor from my favorite place on earth, Honolulu, Hawaii. Now, he currently has, according to his profile, 11 single-family home portfolio, and here's the best part, he's got over 1,200 multifamily apartments and RV units under management. Lane, welcome to the show.
Hey, thanks for having me, Tyler.
Honolulu, man. I got to tell you, when I worked for the government for about 5 years, and my first duty station was Pearl Harbor. And I absolutely love Honolulu. I just love that Oahu, the entire island. It's so beautiful out there. You're lucky.
Yeah, I got to admit, still go to the day job, but when I walk through the parking lot, Diamond Head's right there, and I can see about a third of Waikiki and about a third of the island. So
yeah, nobody's feeling sorry for you.
Yeah.
I gotta say, the only thing I didn't like about Hawaii is I wish your water was a little bit warmer. Being from Florida, I'm used to bath water here. The water here gets like 90 degrees, 80 in the 80s and 90 degrees, and your water's a little cooler there out in the ocean. But otherwise, that place is paradise on earth. So I can see why you live there.
Right. Definitely is a little more expensive to live here, though. That's the problem, but it's worth it at some point.
Yeah, it's absolutely worth it. I've actually thought about buying a property out there, maybe a vacation rental or something, just to be able to come out there. Like old Brandon, I guess, at Bigger Pockets, he just bought a place on the Big Island, and he's hanging out in the Big Island over there. So,
cool.
So, you've been doing this a while. It's interesting. You're a civil engineer, which I find what I find fascinating about that, besides the fact that you're an engineer, is that I meet so many people who are engineers who wind up getting into real estate investing usually pretty early on in their engineering career. Can you kind of shed a little bit of light on that? It seems like every syndicator I know either currently is or used to be an engineer. I think I'm the only one that's not an engineer. I mean, Michael Blank is an ex-engineer. What is it about engineering that makes everybody come to real estate?
Yeah, it's two things. I think the first is the obvious, right? Like, engineers are good with numbers, but this real estate stuff is not that hard, right? Like it's
right.
It's income minus expenses equal profit, and see if you can do it again and again and again. But I think the second ingredient is probably the biggest thing, and for a lot of people with kids trying to raise kids, it's that element of financial pain or some kind of scarcity of money. A lot of engineers, we sit there and we kind of toil in our heads at our jobs where it's like, geez, I'm not going to be able to buy that BMW or Mercedes at some point. I'm going to have to work at this job for the rest of my life. And, I think also engineers, at work, you can work with people, things, engineers work with a lot of numbers and things.
Right.
we don't get to be like a doctor and heal somebody and see the benefits of that firsthand.
Right.
We always we play with our computers and somebody tells us what to do, and usually that somebody isn't very good with people to begin with is another engineer. So it's disheartening, and you don't make that much money. I mean, I work with a lot of doctors and lawyers, those guys, and it's kind of amazing when they kind of find me, because I'm like, aren't you happy with the salary you're making?
Right,
I mean,
right.
but yeah, the engineers have a big pain point.
I can imagine. So there's so many of you in real estate investing, but it's great because it's important. And the thing what I like about working with engineers in the real estate space is that you are by default, or you're trained to be detail oriented. So, the devil's in the details, as they say. And I love the fact that working with engineers, I've got capital partners that are engineers, and I've got people like you that I've worked with in the past that are engineers, and you guys are really, really good at the details, which, full disclosure, Tyler's not so good at the details. I'm kind of a spaghetti on the wall kind of guy, but always nice to have somebody in the team or in the mix that is good at the details. So I really appreciate having that aboard.
Yeah, my friend who was kind of like more of a free-spirited guy, when he was buying his house, you've got to sign a lot of disclosures, and he asked, does anybody read this? And then the gal said, yeah, these engineers read every single page of this.
Exactly. Now, I when it comes to documents, I am that guy. I will sit there and read every single sentence, and if there's something on there I don't understand, I will stop dead in my tracks, and I just wear out the title companies. They're like, really, dude? Come on. You've read the Florida contract 20 times. Do you need to read it again? It's like, well, just sure. But
there's something else that you probably appreciate. They're like, engineers, they think with the numbers. They don't get emotional, and you're
exactly
kind of like, okay, this is what you make. This is what expenses there are. Okay, cool. Where do I sign? Right? Like, it's kind of maybe a little bit dyslexic, or like, it's very no emotion tied to it. It's like, all right, Tyler, here we go. Like,
well, you're very scientific, which is cool. I mean, you do, like the real estate guys say, do the math, and the math will tell you what to do. I think Robert Helm says that. And that's absolutely true. You guys sit down, you do the math, and I'm really the same way. I sit down, I do the math. If the math makes sense and the data that led to the math makes sense and it's from a reputable source, then let's go.
Right.
Right. We can not pull triggers all we want. We're never going to get anywhere, but I like the fact that you're out there pulling triggers, making it happen. Speaking of which, you built your portfolio up to 12 houses, which is by itself no small feat, because 12 houses, I've been down that road. I used to be a rehabber. 12 houses is a lot of work. And now you make a jump to apartments, and you built a healthy portfolio as a syndicator and whatnot. You got a lot of units under management. It's an impressive portfolio. Why the change? Why start in single and then switch over? Why not just maybe buy packages, a single family or something?
Yeah, and I think a lot of people get to this position where you're pretty good at single family homes. I mean, I started with Turnkey Rentals, and I kind of, got good at that. I guess there's not really much to get good at, right? It's freaking Turnkey Rentals at the end of the day.
Right, yeah.
It's not that hard. But, do the math, right? Like, you spend a month or two to find a property, put on due diligence, go through due diligence, and then, things happen and it falls out, do it all over again, go back into it. And finally you close on the property, all for what? Like $300 of cash flow.
Right.
In the beginning, it was cool, right? Rinse, wash, repeat, do that a few times. But then you quickly realize that it's not scalable. So I got to about, 10, and I was having like an eviction or two a year, and then 3 or 4 big issues that happened, whether like a HVAC broke or a plumbing issue, and all for what, 10 times 300 is $3,000, $3,000 passive a month, which is all right, but that's not enough. I mean, you probably need about 10,000 to kind of make an impact on anything. So
correct,
that'd be 30 houses. So now you're just multiply that number by 3. So an eviction every other month and catastrophe every month. It's just not scalable. And then I just started joining different masterminds and clubs, and these guys were all kind of saying the same thing. Like, I wish they would have got out of single family homes sooner.
Right? That's very interesting. Now, so as a lot of folks listen to the show, they may or may not know what a syndicator does. I don't talk a lot on my show about syndication, but because I leave that to people that come on the show, guest as yourself, to talk more about syndicates and how it works, and so they get a different perspective besides mine. That's why I have folks like yourself on the show that are experts in it. Most of my deals have been single investor to a particular asset, so we don't have to get into the syndicates because we're doing essentially smaller deals in most cases. What is it like making that initial jump? It's like, it sounds like, and although we were just working on a deal together, it sounds like on the surface to most lay people, it would sound like a ton of work. It's like, wow, you go from 12 of something to 1,200 of something. That's for the lay person. That sounds like a ton of work. So what do you say to that person? It's like, oh man, that's way too big for me. I couldn't do that.
Well, cool. Don't do it then,
More for you.
But that's the beauty of it, right? Like
Exactly.
when there's this mental block, like anything, just like assisted living, right? Like, people get into it and they're like, oh, this is like a business,
Right.
Well, that's exactly the reason why you should do it, because people get scared. They're like, well, let me just go back to my single family homes and just do that. Like, the profits are kind of when the competition goes away.
Right.
And in this case, the competition just gets scared. But like in anything else, it's like pretty simple. I mean, you get a lawyer, you drop paperwork. The paperwork is pretty expensive. I think that's a deterrent for a lot of people. I mean, you're kind of talking on the magnitude of 10 grand to do a PPM, right? But I mean, not a lot of people aggregate capital and to get above that mom and pop investor amount and kind of play in that vicinity of, small enough to fly on the radar of the big institutions, but big enough to, definitely get better deals in the mom and pop investor crowd, kind of fighting tooth and nail with each other. So in that $2 to $10 million zone, it's kind of the sweet spot.
What I find interesting, what you do is your focus is raising money. In other words, you leverage your expertise in analyzing deals. You're really, really good at underwriting deals and analyzing deals. You leverage that into focusing on raising capital. I heard you on, I believe it was Michael Blank's podcast, talking about that's really your focus is raising capital, teaming up with other syndicators that are finding the opportunities and negotiating the deal, and you're coming in as putting your expertise into the underwriting, and then stepping in and representing other investors behind you. Is that basically how it works?
Yeah. Like, so a couple of years when I was kind of making this shift, a few years ago when I had this mind shift, I need to go bigger. I joined an apartment mentoring group, because I wanted to be an operator, right? Like I wanted to go out and lead my own deal. So, I went on all the bus tours, analyzed all these properties, probably analyzed like 300-400 of them in a matter of 6 to 18 months. Didn't find anything, I was living in Seattle at the time. To find deals, you really got to be like taking brokers out to lunch every other week. I don't know where people getting in their head that they just can't find a deal. For most of these guys, it's taken like 12 to 18 months to find that first deal that actually makes sense.
Absolutely.
So I was just, and then I started to realize, like, I don't like being an operator. I wouldn't want to be an operator. It's hard work to be a Class C multifamily lead. And then I kind of saw how much money I had. I mean, I'm not an accredited investor yet. I'm getting there, and I just realized that I don't really need to be the lead. I don't need to get paid that big general partnership split.
Right.
So I was like, well, I'm just going to be a limited partner because I know how to analyze these deals. And, so I switched more towards, joining clubs and masterminds to get to know people. And that's really a big part of all this, trying to read the deals is, meeting the people, getting to know them for who they are and building your network to encompass, who are the past people in their deals. Can they vet for their previous deal sponsor?
Right. How did you, one thing I learned from being on calls with you and kind of being a fly on the wall as I'm growing in the learning process is you are absolutely an expert in underwriting. Did you take a course for that? Is that something that just evolved over time? What did that look like?
Yeah, I mean, that kind of came out of the apartment mentoring group. There's a lot of them out there, and it just takes a while. Right. I mean, I think, you hear on podcasts and, podcasts are great, but I stopped really listening to them a long time ago because I think I heard it from Grant Cardone. People ask him, well, what kind of books do you read? And, that character always comes up with the best answers. And he says, I don't read no damn books. I just analyze a lot of properties. And he is right. Stop listening to podcasts, stop reading books, and just, go and analyze 500 deals.
Yeah.
Because after that, you're going to get a sense of, how to see the numbers, but actually what's out there in the marketplace, which is kind of changing. I mean, things, they slowly move towards one area.
what I find interesting is, and you're absolutely right, I can't argue with you, is that the people do spend a lot of time tied up in the I don't know. And they'll freeze because of the I don't know, which is, I guess, great, because when you're a syndicator, that's outstanding, because that's your ideal client, right? They're not going to take the action without you because they're terrified to jump into the space. But I like that. Get out there and do. And you're right. I don't feel that the mathematics involved in putting together a real estate deal are rocket science. I mean, it's basic addition, subtraction, multiplication, division. It's not, we're talking about advanced math here. It really, the numbers work or they don't work. And if they don't work, there's really only two things you can do. You can change the price or change the terms. But you can't change what's already happened. You can't change where the way things are today. And I'm a believer, and I know in the bigger space, you guys do things a little differently. In the bigger stuff, I buy or make offers on the small to medium sized stuff based on what the property does do. In other words, what I don't want to do is reward a seller for doing a lousy job underwriting or managing a property, rather, when they're doing it and they run it in the ground. I'm not going to pay them as if it was producing 50 grand a month when it's producing 10 grand a month. And I know one thing I think I've heard you say before on a couple of podcasts I've listened to, and I absolutely agree with this logic. You probably see too that there's a lot of syndicators out there that are just kind of raising money, but not taking a whole lot of responsibility for the quality of the deal. And I know you do spend quite a bit of time making sure, vetting who you're working with, number one. But more importantly, really taking another approach, looking at it again. In other words, not taking it at face value. Is that pretty accurate?
Yeah, I mean, I think the numbers, the way it works out is, if you have 1,000 deals, probably only about 5, 10 maybe make it to, a smart investor will be like, okay, this is good enough to go and syndicate this big deal.
Right.
So of those, I would say probably 1 out of 5 kind of make it through my filtering process. It's something I'm kind of working on, is trying to, build my network with more leads, because that's what I essentially do these days. I'm the deal hunter.
Right.
I go out and people who kind of find these deals and put them in their contract and kind of work up the deal. So what I'm looking at is the executive summary put together by the syndication group. But, there's really nothing in there that tells you if it's a good deal or not. They don't give you the rent rolls. They don't give you the P&Ls.
Right.
They don't give you the rental comps. They give you this garbage about what the last thing sold for. But, this is all based on NOI. So what the heck does that have to do with anything?
It doesn't.
And then there's those fancy marketing pages with hey, this is what the state of Georgia is doing in the last 5 years. It's okay, there's Kentucky Fried Chicken and Walmart. It's nice, I guess, but that's useless, right?
Absolutely.
The P&Ls and rent rolls, that's a big part of it, and it's not even given to you. And then it's digging into the details, what are the assumptions that were used? Was it 2% rent increases? Was it 3 or was it 5?
Right.
What was the reversion cap rate? That kind of stuff can make 100% in 5-year deal go to 150% return in 5 years, or the other way.
That's a big difference.
And as a limited partner, most investors investing in limited partnerships, especially a lot of the accredited guys, I would say a good 80% don't know how to really analyze the deal. I mean, they probably have single family homes themselves and understand the numbers, but
sure.
I doubt that they've analyzed more than 50 or 100 of these deals the right way.
So I like what you say. It really comes down to getting up there, rolling up your sleeves, looking at where the data originated from. In other words, the assumptions. Because at the end of the day, all investing is to some degree has some degree of speculation in it. That's just reality. I know you see, and I see this as well out there in the space, is this, pro forma cap rate. It's well, based on completely guessing, we think that it might do this. If this happens on a sunny day and it doesn't rain or the clouds don't come over that day, then it might produce this. So looking at that, you're tying back to, okay, what are the assumptions? Like you said, if they're assuming a 10% annual rent increase, well, that equals an empty building after year one, right? Because everybody's going to bail out. If you start raising rents that high, that quick, you're going to scare away all your tenants, which frankly, sometimes a strategy on purpose. If you need to empty a building, that's one way to do it. But when they're looking at more conservative, when you see more conservative things like maybe a 2% increase or a 3% increase annually, is there a sweet spot that you're looking for that makes sense, or is it more market driven, or what are your thoughts on that?
Well, traditionally, like, you try and use like a 2 to 3% rent increase per year on something. But there's, that's just one space in the spreadsheet. There's probably
Right.
about a dozen things you can kind of play with, and and it's kind of messed up because everybody knows what investors want. They want the 80 to 100% return in 5 years, or that's 17 to 20% IRR. So it's just starting from there and just tweaking the numbers to get that. And it's, call it right or wrong. That's what everybody else is doing. So as a syndicator, you kind of have to do that too.
Right.
So I mean, here's a story from the past that I had two deals out, and one deal was put out at this number, and then I had another deal that I was kind of came out after, and I felt like that deal was definitely a stronger deal, but we underwrote it. We did the initial assumptions a little more conservatively, so it wasn't showing as good. I was like, shoot, like this one's a better deal. Like,
Right.
so had to play with some cells on the spreadsheet to get what we wanted.
Tweaking those numbers.
Right. And it's not good, but like, it's frustrating when everybody else is doing it and they're just blowing up the spreadsheet to get God knows what. And what it really is as a syndicator, you're just kind of kicking the can down the road, and you're trying to, you just blame it on the economy, if you don't hit your numbers.
That's kind of scary.
Yeah, it's kind of scary. And not to deter people from going down that way, but just know that this is where the people thing has to come into effect in the track record.
Well, absolutely, because I see some deals that are getting. I'm looking. I focus a lot on closings in certain markets, and I'm watching to see what's. Not that I'm looking for comparable sales or whatnot, but I'm curious to see the psychology behind a lot of these deals. So I watch them do the cap raise on it, and I see it close, and I know what the kind of returns they're offering and what they're projecting things to be. And in a lot of cases, I'm seeing things that there's no way that'll perform like that. It's just not possible unless some sort of divine intervention comes in. It doesn't make sense. Yet people will blindly invest in it. The syndicators, like you said, are blowing up the spreadsheet, and that's concerning. I'm concerned for what happens down the road when we have shifts in the economy. How's that going to play out?
Yeah, and these guys are super confident about it. I'm like, you guys do what, like 6% rent increase per year and 95% occupancy, and it's like, this is how you guys do it. And like the guy is like a lot older. He seems to have a very professional profile picture up.
Right.
And he's like, yeah, that's how we do it.
Okie dokie.
I'm like, okay, interesting. And then I go look him up later. No one has ever heard of the guy. And then come to find out the guy has never done a deal. He doesn't even own single family homes.
Oh, no.
Like, okay.
Oh, no.
That's what people are teaching these days.
Yeah, well, there's a lot of that going on. It seems like lately there's been a new boon of apartment type trainings out there. I'm seeing everybody's popping up with a big apartment, the big commercial apartment boot camps, and 50,000 this and 100,000 that. So I guess that's going to take a lot of people coming out of it now with wanting to take the shortcuts, because even if the educator's really, really good, I know for a fact, because I've talked to people. Rod Cleef, a buddy of mine, he's a great guy. He has a great training program, but I know people that have come out of there and they're not listening to him. They're not, because I think the psychology behind it is, well, I showed up, I bought the book, therefore I know enough, and I'm just going to run out there half cocked and not really pay attention to what's in it, so to speak, which is a little scary, but what can you do?
Yeah, and it's a very fragmented kind of product. I mean, no deal is the like. I mean, people ask like, well, how is this to the last one? It's like, well, it's different market and just different everything. It's hard.
Absolutely.
And when you see enough of these things, I think that's the main thing, is just start taking pitches on this stuff and just seeing that, they're all a little different, but once you get the hang of it, it's simple. It gets to be second nature.
Let's talk about my favorite topic in the world. It's time. You work full time, and I'm sure you got a little bit of surfing going on if you're in Hawaii, right? You take time out to go surfing, don't you?
Well, I've only been to the beach a couple times since I moved back, 7-8 months ago. So
that's for me. That's just.
I probably need to start doing that more.
Yeah, you do. I mean, why? You're in Hawaii, dude. Come on. Jeez. But anyway, so working full time, syndicating on the side, right? Or which you make a big impact. I mean, you've got your own podcast that's doing quite well. You got a big following. How do you manage your time? I mean, how do you handle all that? Do you spend a lot of time with the syndicates, or do you just rely on the resources of others in the deal, or how's that work?
I think I've always just been very good at managing the time that I do have. I call it you go to work, and I've been lucky enough to kind of been able to take easier jobs. I used to work in private, and then I worked for the government, and still work for the government. So I do my job, I get my work done, but then there's this other time when I come home because I'm not totally drained. I don't have a commute. But it's just like, what are you gonna do when you come home? Like watch Netflix or spend 2-3 hours on doing this other stuff?
Right.
I think that's like, I do that every day. Like right now, I come home and I work till like midnight every single night, and I work 8 hours on this stuff on the weekends, on Saturday and Sunday, and it's probably not sustainable, and I don't recommend it for everybody. But at some point, I'm gonna pull the pin on the job and do this full time. But that's how you gotta start that flywheel, I think, in the beginning.
I agree.
And I tell a lot of people, like, look, you're picking up single family homes, you're trying to do your research, just try and put in that 2 hours every night. Just be consistent about it.
Well, I think the consistency is the key. Is if you're all over the place, like exercise, right? If you set your mind to exercise 3 days a week and you exercise 3 days a week consistently, you will lose weight and feel better. You'll look better, the whole 9 yards. Same thing with building wealth. You invest in your business in time. So I like that right now, yes, you realize that you are working a lot of hours. However, it's not that there's no end in sight. It's a temporary thing to get to a certain place to where you can pull the trigger, exit the job type of thing, and then move on to bigger and better things doing your own time. So with that, when you're just strictly raising the money in a deal, once it closes, is there much for you to do in your role in most cases from what you've seen, or is that pretty much it, just maintaining the relationship with the investor until they exit the property? What's that look like?
Yeah, I mean, the one of the big things is kind of like the communications, and it's I think a lot of people don't do a very good job of like staying up on top of the deal in terms of like just communicating and being transparent what's happening out there with the deal. I think a lot of it's the selling is sort of on the front end. You get the money in, and then you'd be lucky if you you hear anything else. But we like to do the monthly email update, whether it's, I don't know, I don't want to say it's quite 500 words, but it gives, hey, this is where we are in terms of projections. This is the occupancy. These are how the rents are trending. Ooh, last month, we got a couple absorbed at like a really high rent, like at $20 more than we thought, and here are the spreadsheet with all the financials, and here's what we're projecting out for next distributions in a few months. That's kind of like the flavor of kind of what goes into a monthly update, and those monthly updates sneak up on you quick.
Yeah, they tend to, right? It's like a podcast episode. It's like, oh, I got to record an episode.
Another one.
Sometimes I think, I always tell myself when I give it people, I go to Podfest and a lot of the Podfest conventions, I speak at them and whatnot. When I go there, people always ask me advice. They say, what's your best advice? I always tell them the same thing. Make sure you bucket your episodes, right? Of course, I'm the guy that means well. It's actually on my calendar as a time block. Does it ever happen? No. This episode will probably be aired next week because the bucket's running thin, right? It just gets like that. You get, I'm working on a book right now. I'm writing a book, and that's taking a lot of my time. And I got a coaching program going, and that's taking a lot of time. So these things tend to eat in your way. So I like the fact that you do keep in contact with the investors on a regular basis. That's really good news.
Yeah, I mean, as far as the investment goes, I mean, that's why I think this is why it's superior to being your own operator, because you've got somebody on the team who is there all the time. And I'm not talking about like the property manager. I mean, the property manager is a vendor. They don't care.
Right.
At the end of the day, that's a $15 an hour person. I don't want a $15 an hour person managing a multi-million-dollar asset. I mean, I want somebody who is in the equity team, in the general partnership, has skin in the game. Right. Who's boots on the ground. I think that's a big thing that I look for, because I mean, that's what, when I was in my group, that's what a lot of people looked for in the first place. They don't care where the deal is. They first question is always, who's going to be boots on the ground? Right. Where do they live?
Yeah. And what's their background? What's their track record? Are they going to be able to do these things? That's all good stuff. I like that.
Right. And, granted, like they don't really need to have that much experience as long as somebody else in the general partnership does. But as long as I think there's a peace of mind in knowing that somebody's there and, that they can kind of report back. I mean, it's not rocket science, this stuff.
That's true.
But, they don't need to be the smartest guy in the group, but they report back to the team and they can respond quickly.
When you kind of an off topic but on topic question, and I kind of want to wrap up with this one. This is, I think, a good one. You talk about reversing the pyramid of traditional investing. Can you touch on that?
Yeah, I think, when I was, working at a day, when I still do, but like, when I was kind of young and they kind of tried to brainwash you and they bring the 401k guy in from the big brokerage house, they come in and they're like, oh, you start out, you got to go with this something 500 index fund because it's mostly stocks and less bonds because you guys are young, you guys need to go out and take the risks and you got time on your side, all this same stuff they always say. But
right.
I think it's the complete opposite. I think in the beginning you need to be going after the more stable assets, like the single family home. That's like the fundamental. Get a few of them to start out with, get that cash flow going so you can build the cash flow base, get to $1,000 or a few $1,000s a month, then go after bigger things, more riskier things like developments. One of the biggest mistakes I see from newbies is they get this shiny object syndrome and they're like, oh, I'm going to go flip houses. And I'm like, okay, there's no cash flow on that. It's bigger potentially ROI, but first of all, you don't even know what you're doing. You don't even have a good network to support you.
Right.
Or they'll do things like, oh, I'm going to, do land investing. Yeah, because that's all the rich people do. I'm like, no, you don't see it. Like what the rich people are doing is they can do that because they're rich. They don't have to worry about putting food on the table.
Exactly.
So this is just my philosophy is like starting out with, instead of appreciation first, starting with cash flow first. And it may not be the quickest way there. You may be buying, junker class C and B assets out in the Midwest that don't really appreciate. But to start out with the fundamentals there and then kind of invert that pyramid as things go along. So, I would say, that's when you start to add the class C multifamily, class B multifamily syndications, and then maybe go after bigger, more high risk, high reward stuff like, different kinds of mobile home parks, self-storage. I mean, those are also very conservative investments too, but more like developments, that 30% IR, that you might get an 80% return in 2.5-year deals.
Nice.
Some of those more, home run plays.
Outstanding. Yeah, I agree with your analogy there. And you got to build that base. And that's why I tell people is, please start with something, get some cash flow going, because then you always have that base. And it makes it so much easier to escape the rat race when you do have that foundational cash flow coming in. I mean, we did some things with our first property, and it's provided that core of which we could build our business on. And, without it, things would be a lot different. I can tell you that.
Right. And I think a lot of people, real estate has been good for the last decade. And, a lot of people have made a lot of money with appreciation, say in their like San Francisco house. And I'm like, well, good for you, right? Like, but if you kind of ride that wave at the wrong time, I mean, that can really hurt you. And it's just not, I mean, it's kind of like investing in Bitcoin or things like that are kind of like that. It's just like gambling.
That it is.
I think also cash flow also kind of changes your mindset a little bit. It makes you more abundance mindset. And I don't care if you read books, until you get that cash flow coming in every single month, like substantial cash, like a few $1,000s. I mean, it's not going to change. You're not going to start thinking differently. I mean, you're not going to start thinking about charities or, bigger meanings, kind of creating something bigger until that starts to come in and you have to stop worrying about putting food on the table.
Exactly. If you can't pay your mortgage, the charity becomes the last thing on your mind. That's for sure.
Right. Yeah. Well, that's the truth, man.
Amen there. So, Leighton, what's the best way? If somebody wants to talk to you about potentially investing, how do they reach out to you? What's the best way to reach you?
Yeah, the best way is, come to my website, simplepassivecashflow.com. Check out the podcast too. And then, shoot me an email, lane@simplepassivecashflow.com. Always looking to connect with people and, people who are definitely, willing to put in the work. I'll put in time and, kind of hear your situation and point you in the right direction. Probably be pretty much the same that you tell them every day.
Absolutely.
But it seems like the right way to go.
It does. It absolutely does. And I got to say, what I love about what we do, aside from the real estate, but being podcasters, is the ability to have an influence on other people's lives in a positive way. I dig that. And sometimes people ask me from the show, they write in and go, dude, why do you have your quote unquote competition on the show? It's like, well, first of all, I don't have competition because we live in an abundance mindset. And what I do realize is that people have different personalities. There are some people they may not gel with my personality. There are some people that may not gel with yours, for example. And by leveraging what we have to offer to both audiences, we can help a greater number of people. It's not about what Tyler does or what Lane does or who's better or who's worse or anything like that. We think, ladies and gentlemen, in abundance. And what you will see that more prevalent, I believe, in the larger assets, the abundance mindset as compared to the single family where it's like, it's mine, it's mine, it's mine, right?
Right. Yeah, and I commend you for that because, not all podcasters are like that. There's definitely some that are kind of just play with themselves and they keep doing single family homes, and there's a reason because nobody wants to work with them.
Exactly. They're a challenge.
Yeah, they're pain to work with. Nobody likes them. They're like scarcity mindset.
Exactly.
And I think at the end of the day, I think the best thing about doing this podcasting thing is you meet cool people and you build actually pretty good friends. Because, most times I'm in W-2 world. I talk about this stuff. They look at me cross-eyed and
oh yeah.
And it's kind of lonely.
There's what's wrong with you, dude? You're just weird. Why can't you go out and have a beer with the rest of us? Well, because I'm busy raising money for a multi-million-dollar deal that'll pay me for the rest of my life. But never mind.
Yeah.
I'll go have the cocktail. Anyway, anything you want to say before we wrap up, Lane?
No. I'll have you on and we'll try and tell your side of the story. I think a lot of times you don't really get to hear that on my podcast. We'll definitely try and dig into your story a little bit. But yeah, thanks for having me.
Oh, always a pleasure. I'm sorry that we lost your file the first time. We had that damaged file, but we were able to reconnect. That's cool. And ladies and gentlemen, the story goes, so we reunite on a conference call about an investment deal where we're both raising money for it. And then it hit me after the call. I'm like, I forgot about that episode. And so I sent him an email after the call going, dude, forgot about that episode. Let's get back and get that finished. So I appreciate you taking the time to come on your busy day and add value to my audience. I definitely appreciate that. Ladies and gentlemen, we're going to wrap there. I will put Lane's contact information that he gave you down in the show notes so you'll be able to access that. Reach out to him, get on the phone with him, schedule some time, bend his ear a little bit. And, if there's something where there can be a mutual value exchange, get to know each other, build a relationship. If nothing else, I guarantee you will learn something from Lane. I know I have, and I continue to do so. With that, folks, we're going to wrap it. As always, if you are not a member of our Facebook group, head on over to cashflowguys.com/group, cashflowguys.com/group. It takes you right over to the Cashflow Guys group on Facebook. We got a lot of folks in there asking good questions, getting good answers. So please feel free to go over there and join. It's absolutely free. And I'm going to leave it right there. I want you to make sure this week you are focused on learning to earn and making sure that you are focused on doing at least one thing to get out of the rat race in your near future. Have a great week.
This concludes today's episode. You don't have to wait till the next episode to learn to earn.
Head over to cashflowguys.com and contact Tyler and his team for more powerful tips and ideas so you can start generating multiple streams of income and escape the rat race.